Can we just start with the energy markets right here and what you're seeing in terms of oil and the declines we've seen the last couple of days?
Hi, thanks for having me on. Yeah, I mean, it's been very interesting. You're seeing that the movement right now is certainly in line with geopolitical tensions. You've been seeing that for the last couple of weeks, and the fact that it's declining is probably a little bit of a signal that some of those tensions are easing back. We're still watching it really closely. I think there's a lot of volatility to come within that sector because it's being driven by factors that, quite frankly, are really difficult to predict.
We got some reassuring economic data toward the end of last week. It seems that everyone is waiting and looking toward Jackson Hole and the sort of comments that come out of not just from the Fed chair's speech on Friday, but also from other leaders there. In the meantime, what data points are you looking for that you think could move markets here and abroad?
Right. So I think the key things that we are looking at is going to be everything to do with the labour market. So we're going to find out some important revisions to backdated payroll data today. That will be somewhat important. The more important one is going to be weekly jobless claims out on Thursday. That's giving us a really timely indicator of how the job market is moving. And of course, after the very weak payroll report a few weeks ago, this is why we're really focused on that. And so far, the data has been quite encouraging. And I have to say, although we, of course, are looking to Jackson Hole, very interested to hear what the various central bankers are looking to say, I think for us, actually, the most important event over the whole month is going to be the next jobs report at the beginning of September. That's going to be the one that really tells us how weak is the economy, how weak is the labour market, and that's going to give us a clear indication to what to expect from the next Fed meeting.
It's funny, if you're seeing data that seems to be reassuring on the economic front, that seems to indicate that the fears of recession should not be immediate at any case. But gold is hitting a new time high. How do you balance what seems to be the hedging that's going on with the reassuring data?
Well, so as you said, the data has been quite reassuring in the last week or two after we had the big scare. But what we are seeing is, I think expectations for recession have just made a shift higher. And people are watching it very, very closely. There is that fear now in people's minds that recession could be on the way, even if it's not quite imminent. And I think that's what you're seeing gold react to, is that although economic data has proved to be a little bit better, everyone is still on tenterhooks to see how this is going to be evolving over the next couple of months. And certainly after you've had such significant tightening from the Fed over the previous 18 months or so, we do know that recession risk becomes somewhat more elevated at that point.
Do you think that the equity markets continue to grind higher?
I do. So we don't believe that this is going to end in recession. We do think this is going to be a soft landing. We're very much reassured by the fact that actually if economic data, particularly labour market data, were to deteriorate significantly, the Fed has a lot of space to cut rates. So against that backdrop, we should expect to see earnings growth still staying solid, not particularly very, very strong, but at least solid. And that should mean that equity markets can make some gains over the next couple of months. But I just I think there will be a lot of volatility. I think the market is going to respond to every single economic data point that comes out of the next couple of months. And that is going to drive a lot of swings in the market.